Good morning, everyone. Today I'll be presenting my analysis on bond duration. We'll look at how different bond characteristics affect both duration and modified duration. My name is Noah, and let's begin. First, let's define a couple of key terms. Duration measures the weighted average time to receive a bond's cash flows. Modified duration, on the other hand, estimates how much a bond's price will change in response to a 1% change in interest rates. Both are essential for understanding a bond's interest rate risk. As you can see, here we explored the effect on coupon rates on duration. As shown in the table, when the coupon rate increases from 1% to 6%, both duration and modified durations decrease. This is because higher coupon payments return move value earlier to the holder, reducing the time weighted exposure to interest rate risk. You can also see this trend in the graph, where the line slopes downward. Next is the impact of maturity. In this case, all bonds have the same coupon rate and market rate, but different maturities. As the maturity increases from 5 to 20 years, durations rises significantly from 4.5 to 13.8 years. This is expected as cash flow are pushed farther into the future, increasing the bond's sensitivity to interest rate changes. Now, let's consider the effect of market interest rates. As the market rate increases from 2% to 5%, duration also increases slightly. Higher interest rates reduce bond prices and increase the relative weight of distant cash flows. This results in a slightly higher sensitivity to interest rate fluctuations, as reflected in the increased duration and modified duration values. Finally, we look at price. When the bond price rises from $85 to 100, increases from 8.6 to 8.0 years. This is because higher bond prices usually reflect lower yields, and more of the bond's value is returned earlier. This shortens the weighted average time of cash flows and reduces interest rate sensitivity. So, in conclusion, higher coupon rates reduce duration, longer maturities increase duration, higher market interest rates slightly increase duration, and higher prices reduce duration slightly. These relationships help investors manage interest rate risk. For example, in a rising rate environment, selecting bonds with shorter durations can help reduce potential losses.
Hello, my name is Joe Gonzalez, and I will walk you through the NBER's analysis of USA business cycles, their impact on investors, and the role of diversification during crisis. All sorted directly from the National Bureau of Economic Research report that our group has collected. Let's dive in. So, number one, how does the NBA select the beginning or the end of a recession? But first of all, before we examine how recessions are identified, let's define what a recession actually is. According to the Cambridge Dictionary, a recession is a period when the economy of a country is not successful and conditions for businesses are bad. But the NBER, which is America's official recession every year, goes much deeper than this simple definition. How NBER selects recession, the start and the end dates. The BR doesn't use the common two-quarter GDP decline rule. Instead, they use the business cycle dating commits three criteria points. What are these criteria points? We have depth, diffusion, duration. What do they mean? Depth would be how serves is the economy decline. Diffusion would be how widespread it is across the industries, not just one. And duration obviously would be how long has it lasted. They analyze multiple indicators, including real personal income, non-formal payroll employment, industrial production, wholesale retail sales as well. Crucially, they weigh into the trends are obviously absolutely clear, which is why the declarations often come months after the actual turning point. As we saw earlier, they waited 15 months to confirm the April 2023. Number two, what period in US economy history was the longest expansion or contraction? From the records and the official website of the NBER, we have found that the longest expansion was post 2009 recovery, June 2009 till February 2020. That's 120 months of growth. The table and graph that I have for you guys up here shows how so basically different this is from the 19th century crisis. For instance, the NBER took just 4 months to declare the 2020 COVID peak versus the 12 months, which was in 2007 peak, reflecting the better real-time data of today. The longest US economy contraction was the 19th century long depression, lasting 65 months from the peak, which was October 1873 to the March 1879. This drops even the Great Depression, which was 43 months duration. Through that crisis was far more severe in depth. Our table shows three key metrics from the 1873 to the 1879 cycle. 65 months of continuous decline, only 34 months of recovery for the next peak, a full 99 months between economic thirds. The NBER data shows how economic reliance has evolved. For example, the Long Depression, which I already mentioned, 1873 to 1879 lasted 65 months, driven by financial panics and deflation, while the Great Depression, 1929 to 1933, was shorter but far deeper. Post-1945 expansion averaged 46.2 months, thanks to the better policies and structural reforms. This table highlights key cycles like the 1873 peak and 1879 throw, with a 99-month gap between throw. The key takeaway, which be modern economies recover faster but face new complexities. And what implications does this have for the investors? For investors, this lag is critical. The market reacts to leading indicators like the yield curves or MPE surveys months before the NBR official recall because of this lag. The S&P 500 bottomed in March 2020, while the NBR's through came 50 months later. Relying solely on NBR dates, it would be too late. Real-time data, payrolls, and industrial production is key for active decisions. And finally, for these next three questions, how is diversification achieved? By spreading the investments across unrelated assets like stocks and bonds and commodities to manage the risk involved. Number two, international constraints about diversification. Currency risk, we have political instability and regulations which can undermine gains. Number three, limitation in crisis. For example, during the events like COVID-19, correlations spike. As the NBI notes, all markets sync together. Diversification safety net phrase when downturns are economy wide.
Hi, I am Reego and I will be talking about the limits of diversification. So this section investigates the limitations of portfolio diversification during major market crises, specifically the global financial crisis of 2008 and the COVID-19 pandemic in 2020. By analyzing the Nasdaq index and three of its major component stocks, which are Nvidia, Microsoft, and Intel, this study explores how volatility and asset correlations change during these periods. Although diversification is typically used to reduce risk by combining assets with low correlations, systemic events like the global financial crisis and COVID-19 can cause correlation to spike across the market. This analysis aims to demonstrate that in times of widespread economic stress, diversification offers limited protection, challenging the assumptions of modern portfolio theory. Based on the calculations of annual standard deviations during the global financial crisis, we can see a spike in annual standard deviation percentages during 2008, most seen in Nasdaq, Nvidia, and Intel. It shows us that the crisis has had a clear impact on market volatility, and it reflects the heightened uncertainty and risk during that time. According to the Week 11, Chapter 19, periods such as the global financial crisis reduce the benefits of diversifications because asset correlations normally rise, which means that most stocks will move together regardless of their individual characteristics. As explained in Chapter 18, this makes it challenging for portfolio managers to manage risk only using normal strategies. Even companies such as Microsoft and Intel, whose return patterns are typically less volatile than the others, were not left behind with increased volatility. This means that their diversification did not work to reduce the losses. This suggests that in crisis times, investors should really rely more towards risk-adjusted performance measures, for example, the Sharpe ratio. The COVID-19 pandemic did not affect all tech stocks equally. The volatility trends differed from 2018 to 2022. Market-wide volatility indicated by Nasdaq increased the most in 2020 to 7.83%, but standard deviations for stocks like Nvidia actually remained high for an extended period of time, and it was peaking to 18.74% in 2022. Which is actually greater than at the peak of the pandemic. More mature firms such as Microsoft and Intel had smaller increases in volatility, which is indicating more resilience. This is explained in Week 11, Chapter 19, that firm attributes, business model growth expectations, and sentiment in the market have a significant influence over how stocks react to system shocks. Week 12, Chapter 20 also points out that hedge funds tend to take advantage of those differences in volatility with long-short strategies, wagering on spreads between firms with volatility and firms with stability. The ongoing high volatility of Nvidia after 2020 emphasizes how uncertainty can persist even in the aftermath of the peak of a crisis, specifically in high valuation sensitive companies. This shows that after major events like COVID-19, it's important to look at individual sectors and stocks, not just overall market trends, so we can better understand portfolio risk and return. The results from both the global financial crisis and COVID-19 periods clearly demonstrate that systematic risk can overwhelm the benefits of diversification. Despite holding a range of assets, all analyzed stocks experience simultaneous spikes in volatility, indicating a rise in market-wide correlations. This challenges the assumptions of modern portfolio theory, which is built on the idea that asset correlations remain relatively stable and that diversification can effectively reduce risk. However, during major crises, correlations between assets tend to increase significantly, causing diversified portfolios to behave more like undiversified ones. As a result, investors may still face substantial losses, even with well-diversified portfolios.